lower than last week. It could appear that the fear and concerns are slowly slipping through the cracks and making their way into the equities market. In this report, we aim to present the recent fundamental and economic news releases that impacted the US stock markets and look ahead at the upcoming events that could affect their performance. Equity traders' confidence in the US stock market appear to have been rattled following JPMorgan Chase CEO Jamie Dimon's letter to investors yesterday, in which he stated, "As I write this letter, the current crisis is not yet over, and even when it's behind us, there will be repercussions from it for years to come." Further fueling the hunt by US lawmakers to maintain their seat of the Federal Reserve, CEO Jamie Dimon continued by claiming that the Fed's stress testing system was inadequate that never incorporated interest rate at higher levels. As such as an image of incompetence and amateurism painted by JPMorgan Chase CEO Dimon may have eroded confidence in the US equities market, with such a bold statement potentially providing additional pressure on US lawmakers to hold the Fed accountable for the mini banking crisis. Thus, US stock markets could potentially suffer as a result or possible future instability surrounding the biggest central bank, which may weaken confidence in the US equities market, leading to outflows into more safer assets. Equity markets received a little joy following the release of the US PMI manufacturing data, which came lower than expected on Monday, followed by the substantial reduction in the JOLTS job openings for the month of February. Recent data suggests that the US might be nearing a stage of economic downturn, as the last time the JOLTS data was this low was in June 2021 during the COVID pandemic. As such, equity traders may be concerned that the ADP non-farm payrolls and ISM non-manufacturing reports today may further reflect economic downturn as economic sentiment appears to be deteriorating. In addition, the ADP report today may provide some insight into Friday's non-farm payrolls data, as such as the anticipation of a reduction may be priced beforehand should the ADP non-farm payrolls reflect a reduction in employment. Furthermore, the statement made by Fed Governor Cook on Friday, in which she stated, "I am closely watching developments in banking sector, which have the potential to tighten credit conditions and counteract some of the momentum," may imply that the Fed is hoping that tighter monetary conditions and harsher credit scoring practices by banks would help in their fight against inflation, as spending by consumers may be impacted by the absence of free credit that banks and corporations enjoyed over the past decade, now that interest rates have risen significantly. As such, firms may have to cut costs and scalp growth plans as access to capital is now much more difficult and could therefore translate into weakness in the equities market. Walmart, McDonald's, and Apple announced this week that they would be reducing their workforce count as inflation worries tighten the noose around companies' neck. The announcement of layoffs by the three behemoths follows suit by actions taken by the counterparts Disney, Meta, Amazon, and others, as their stock prices had taken a beating following fears of a recession. Therefore, a reduction in workforce may have been seen a logical solution to the problem. By reducing their workforce, Apple, McDonald's, and Walmart will be able to reduce their overhead costs, leading to an increase in profit margins, thus translating into higher stock prices, as they may offer this increased revenue to shareholders through dividends or stock buybacks. Furthermore, the job cuts may be seen as a precautionary measure by the aforementioned firms to ensure a healthier balance sheet in the event of economic downturn. In return, this may have provided temporary support of the equities market as stocks become more appealing in the eyes of investors, thus facilitating inflows into the market and spark risk of behavior. Thank you for watching.